A good friend of mine is on pace to make over $500,000 this year, so naturally the first thing that I start to think about is financial planning opportunities. As a single filer, $500,000 of income will put him well into the 35% income tax bracket, which means it's probably going to be a no-brainer for him to contribute on a pre-tax basis to his 401k instead of Roth. A lot of people like the idea of Roth money because it's tax-free later on, but let's look at a quick example of why pre-tax would make sense in this situation. So here are the 2025 income tax brackets. Once again, as a single filer, $500,000 would put him in the 35% tax bracket. So if he maxes out his pre-tax 401k this year with $23,500, that'll create a tax deferral of $8,225 just for this year. So the reason that pre-tax contributions make more sense here is because when he retires and needs to withdraw that money for income, he's more than likely going to be in a lower tax bracket. So while he's making $500,000 today, let's say that he only plans to need about $150,000 per year in retirement income. That would put him in the 24% ordinary income tax bracket. So withdrawing that same $23,500 would only cause a tax liability of $5,640. Obviously, this is a simplified example. We didn't discuss investment returns or his time frame until retirement, but this is one of the main components that you should use to determine whether you should contribute pre-tax or Roth, and it's known as tax arbitrage. So tax arbitrage in this example was deferring taxes at a higher income tax bracket today to pay them in a lower income tax bracket later, but it also works the other way around. If you're in a lower tax bracket today than you expect to be in the future, then Roth might make more sense.